Hey guys, Sharon Joy from Virtual Accounting Strategies here today to talk about some Accounting 101 concepts. So let's jump right in. What's a simple definition of accounting? In its most basic sense, accounting describes the process of tracking an individual or company's monetary transactions. Accountants record and analyze these transactions to generate an overall picture of the employer's financial health. So, what are some basics of accounting? Basic accounting concepts used in the business world cover revenues, expenses, assets, and liabilities. And these elements are recorded and tracked on documents that are named balance sheet, income statement, and cash flow statement. So let's talk about some basic accounting concepts. An introduction to accounting frequently talks about assets, liabilities, and capital as fields of three fundamental concepts. Assets describe an individual or company's holdings of financial value. Liabilities are debts and unpaid expenses. Capital or equity describes the money the entity has on hand. So let's delve into 7 basic accounting concepts. So the many concepts professionals in accounting use to help them provide the best services to their clients, whether professionals or businesses. Some of the most common concepts include revenue. For a business, the total amount of money the company receives for selling services and products is its revenue. This means it's a company's gross income before deducting any expenses. You can do this by adding all of the company's earnings, equity increases, and interest it gains over the reporting period. A company may deduct its tax liabilities or various expenses from this revenue to determine its profit. So let's talk a little bit more about this. So a revenue is your sale that you've made. It's not the cash that you've collected. It's very important to make this distinction because one of the accounting concepts that we base the accounting industry on is called a matching principle. It's very important if you're using the accrual-based accounting that you recognize a revenue as at the point of sale. It's not the time that you collect. So like if I made a sale today, but I put it, the person's not going to pay me until next month, we need to record the revenue this month. And next month, when we get the cash, we'll record the cash side of the entry. We will not record the revenue again at that point in time. Second concept is expenses. Expenses are the costs a business incurs to generate the revenue. It's the amount of money that you spend basically to run the business. It includes supplies, materials, rent, advertising, salaries, repairs, taxes. Let's give an example. So a restaurant manager may purchase ingredients regularly from a supplier to operate the business. To earn the income, a business aims to have its expenses to be less than its revenue. It's kind of like, think about, a budget. Of course, you want money coming in to be more than the money going out. So again, the expenses is just what you're paying to run a business. Third concept is an asset. Assets are resources a business owns that bring an economic benefit. There's current assets and non-current assets. So a current asset is the resource the business will use within 1 year. So some examples are cash, checks, receivables, and inventories for sale and prepaid expenses. Non-current assets are long-term assets that can provide benefits to the company for more than a year. These are like stocks, bonds, land, building, an automobile, a computer. So these are things that have a long life. Fourth concept is liabilities. Liabilities are economic obligations or what a business owes to other organizations, such as lenders and creditors. So like assets, liabilities can also be current or non-current. A current liability are payments that are due within a year. And these are things like accounts payable, short-term loans, installments on long-term loans, and tax obligations. Again, these are things that are going to come due and have to be paid within 1 year. A non-current liability are obviously the flip. There's things that will not come due for a year. There are longer term items like long-term bonds your mortgage, deferred taxes, deferred obligations. These are things that, like your mortgage is a 30-year mortgage, so that's a long-term liability. Fifth concept is capital. Capital can be anything that provides value or benefits for a business owner, including assets, machinery, property, inventory, patents. Although cash can be a type of capital, capital usually refers to investments that generate wealth for a business. So let's talk about some types of capital. There's working capital. You calculate working capital by subtracting the current liabilities from your current assets. Working capital includes liquid capital or cash assets a company uses for daily operations and short-term payments, such as covering debts and accounts payable within 1 year. Equity is a stake owner's share in the business or any asset they own, meaning this is the money that shareholders invest in the company. If a business liquidates its assets or sells all of them for cash to pay off all their liabilities and debts, what's left over is the value that the shareholder will get, and this is what is known as equity. Debt. Businesses can get debt capital through borrowing loans and bonds from banks and private governmental organizations. Because it's a sizable amount of money at one time, debt capital can enable a business to invest in its future and expand. A sixth accounting concept is accounts. An account is a type of transaction such as cash or sales. Businesses record accounts in a general ledger, which is the accounting book that stores and organizes transactions. Accounts receivable include the money customers owe a company for goods and services. Accounts payable are the money a business owes to creditors and suppliers for goods and services. Seventh concept is financial statements. Financial statements are the documents that show the transactions of a business or a person. So a couple different types of financial statements. There are a few others other than these, but these are the main ones we're going to focus on. There's the income statement, which is also called a profit and loss statement. This is the document that details a company's financial performance by reporting its revenues, sales, costs, expenses during a period. The balance sheet. This is the financial document that reports a company's assets, liabilities, and equity, and it shows where a company is at any point in time. The balance sheet is an ongoing document, whereas an income statement is a cumulative over a period of time. So an income statement you can look at, normally it's for a fiscal year. So a fiscal year could be either a calendar year, which goes from January 1 to December 31, or it can be a fiscal year where some companies choose to have their year start like maybe June 1st or July 1st and runs from July 1st to June 30th. So the income statement shows the accumulation of expenses and revenue during that period of time, whereas a balance sheet is a snapshot at any day, any week, any month, any specific period of time. A third statement that we'll look at is the statement of cash flows. So these are statements that report the amount of cash that a business has earned and the amount of cash that it's spent during a period of time. It shows the inflows and the outflows of cash within the business. For example, it shows the outflow of cash to pay for accounts payable. It shows the outflow of cash to pay for inventory. It shows the inflow of cash that you've collected from accounts receivable. It shows the outflow of cash that you've used to make an investment. So that's all of these movements of cash are shown on your statement of cash flow. So those are the 7 basic accounting concepts that I wanted to touch base on today. So if you'd like to work with me a little bit more, feel free to click on that link below, and hopefully I will see you soon. Take care of yourself.